I'm sure you've come across several videos discussing strategies on how to invest in real estate, but some of these simply don't apply where you live. So today I'm going to talk about the difference in real estate investing between the US and the UK, and more importantly, what this difference means in terms of strategy. If you're new to the channel, make sure you subscribe so you don't miss similar videos. So let's dive into the 5 differences. Number 1 is your fixed rate mortgage. Frankly, this one makes me envious. In the US, you can get a 30-year fixed rate mortgage. For example, here's how much a $650 property in Austin, Texas would cost you. 2.5% interest over 30 years. No such luck here in the UK, and the most common mortgages have a fixed 5 to 10 year rate, with the remainder being a variable rate. Am I confusing you with fixed and variable rates? Okay, let's break it down. So, a fixed rate mortgage means the interest you pay is fixed over a period of time, usually by means of a contract. This means that you know for sure what you'll be paying irrespective of the economic conditions in the future. And historically, the interest rate right now is the lowest it's ever been, both in the UK and the US, as you can see from the following charts. You can literally go back hundreds of years and not find interest rates that low. This is mainly due to central bank action to stimulate the economy by keeping interest low. So if someone offers you a 30-year fixed rate mortgage right now, you would probably want to lock that in right away, because you're guaranteed to pay such low rates for the whole 30-year period. This reduces the risk that you will default on your payments, as if the interest rate goes up, you won't have to pay any more. But on the other hand, it makes business risky for other lenders, as their money is earning them relatively low interest over a long period, and they could have made higher returns if they had the ability to adjust their interest rates. This is why in the UK, lenders do not commit to a fixed rate of more than 5 to 10 years. And the variable rate means they will adjust your interest rate according to movements in the base rate. So that's good for banks, but not so good for homeowners looking for stability. Number 2 is the real estate appreciation rate. When you're working on your real estate investment strategy, inevitably you would have to assume a certain appreciation rate for the property. That is how much you think the house value will grow by. These vary by location, that is, you have to factor in neighborhood, city, state, and obviously country. So how different are the UK versus the US house appreciation rates? Well, from 1980 to 2020, the house price index in the US rose from 100 to 456. That is a 356% gain over 40 years, which roughly translates into an annualized return of 3.87%. But let's be generous and round it to 4%. Over the same period, the house price index in the UK rose from 10 to 124, which is a massive 1,140%. That is more than 3 times that of the US. But on an annualized basis, that's 6.3%. Hold on, something's not quite right here, isn't it? An increase in annual return from 4% to 6.3% means your total return jumps from 356 to 1,140%. That's huge, and all that from a 2% difference? No, surely there must be something wrong. Unless it's the compounding genie at work, which is perfect because I made a video to explain the impact that compounding can have on your lifestyle choices. The link is up here and in the description below. I have to admit that the results were a bit of a surprise. No, not the compounding effect, but the fact that the UK houses have appreciated faster than in the US. So perhaps that's a topic for another video, and if you're interested, make sure you have the notification bell enabled so that you don't miss it. At number 3, we have house hacking. So perhaps like many of you, I first came across the term house hacking from Graham Stephan's channel and love the concept. The idea behind house hacking is simple. You buy a duplex where you live in one unit and rent the other unit such that it offsets at least part of your mortgage. If you're lucky, it pays off your mortgage completely. Genius, right? Except that doesn't really work in the UK. Duplexes are not very common here, and the ones often listed on leading property websites like Zoopla and Rightmove aren't really self-contained independent units. So the duplex definition in the UK implies some communal areas or shared facilities, and that comes at the cost of your privacy. Again, I wish there were proper duplexes in the UK, but you have to understand that the UK housing stock is one of the oldest in Europe, and duplexes are a relatively modern concept. I personally like modern houses, something more like what you'd see in grand designs. Just like this. But what about you? Do you prefer an old stylish house or a modern looking one? Let me know in the comments below. At number 4, we have tax write-offs. So, if you're buying real estate through a business, you can write off the interest as an expense in your profit and loss statement. That's true both in the UK and the US. However, in the US, you can also write off the house value as depreciation. That's right, residential rental property is depreciated at the rate of 3.6% each year for roughly 28 years. Now, depreciation is a commonly used expense category to record a loss in value of the useful life of an asset. Think of a car that has a life of 20 years, after which it has a scrap value. So over its lifespan of 20 years, it's been gradually losing value, and that annual loss is what's passed as an expense in your P&L. Okay, so that makes sense for a car, but for houses? What? Houses appreciate, right? So if you depreciate an appreciating asset, you're basically doubling the benefit? This baffles me, and I have no idea who came up with the idea. But however, it works great for business owners. Now, I'm not an accountant, but I'm pretty sure that in the UK, to claim depreciation, you would have to show a decline in asset value, and the depreciation rate will be directly proportional to that. Finally, at number 5, we have first-time buyer schemes. Property prices have risen much faster than income over the last decades, and as a result, young people are finding it hard to buy a house. This is particularly true in London, where I live. So, the government has set up schemes to help first-time buyers, and in the UK, the scheme is called Help to Buy. Help to Buy has two routes of home ownership: shared ownership and equity loan. In a nutshell, shared ownership allows you to part buy and part rent, slowly increasing your equity in your property until you fully own it. Shared ownership does not mean you share your living space, but simply the property belongs in part to you and in part to someone else, usually a housing association. The scheme subsidizes your rent, which allows you to save more and hopefully increase your share of the property in steps known as staircasing. With equity loan, on the other hand, the government provides first-time buyers with a 0% interest loan for either 20% or 40% of the property value. Buyers are only required to have a 5% deposit from their own pocket and can take a mortgage on the rest. The advantage here is because you have a 0% loan for 5 years from the government and low deposit, you end up having to take a smaller mortgage. Otherwise, you may not be able to get a large mortgage based on your income. But do such schemes exist in the US? On the government website, I found the Federal Housing Administration Loans Program for first-time buyers. Similar to what I mentioned earlier, the requirement is less strict for first-time buyers, with a deposit of only 3.5% required, and having a good credit score is not necessary. However, there is no 0% loan provided by the government or subsidized renting, which means it's somewhat less of a push. So there you have it, 5 huge differences between the US and the UK when it comes to real estate investing. Now it's your turn to tell me which one you thought was particularly interesting, boring, or even shocking. Let me know in the comments below. And also, if you enjoyed my video, make sure to click on the like button as it helps YouTube rank my videos better. Thanks for watching, see you next time.